Steve here with IBC Global. In today's video, we are going to talk about how you can buy a whole life insurance policy if you're purely interested in the cash value. When you look at a whole life insurance policy, it's very common to see individuals and large corporations express interest in whole life insurance for the cash value, mainly for three reasons. One, it's a safe place to put money, regardless of what's going on in the economy or stock market. I always see my cash value go up. Two, it's liquid. I can access the cash value anytime without any penalties, and it also has a unique loan feature in the sense that if I decide to borrow against it, my cash value keeps on compounding as if I never touched it in the first place. And then three, if we do everything right, I can access it completely tax-free. So when it comes to whole life insurance, people often hear about that. They're interested in the cash value, but then they see a policy, look at the numbers and say, why on earth would I put my money here? So today we'll show you exactly what not to do and then what to do in order to get a whole life insurance policy for as much cash value as possible. So what we're going to start with is a basic whole life insurance policy. And this is what most individuals who either own whole life insurance or have been presented whole life insurance have seen. So what we've got here is a basic whole life insurance policy. We're going to assume you just buy a death benefit of $1 million, and your insurance agent says to you, it is going to cost you $20,000 per year. And you can pay into this policy forever, or if you'd like, you can stop after 15 years. Let's take a look at this. So we'll start with a traditional whole life insurance policy, and here we go. So when we look at this, what do we see? Toward the top right, you will see your premium. We've got a 40-year-old individual, $20,000 premium. That $20,000 premium buys him just over $1 million in life insurance. In this example, we see that he continues to pay the premium forever. You ever see Sandlot? Forever. Most people don't like that. Paying forever. Most people, I would say, do like Sandlot. All right, number two. Here is the exact same policy, but what do we see? When do premiums stop? After 15 years, nothing goes in. Let's take a look at these two side by side. It'll be a little bit easier to follow this way. So what we've got here is firstly, paying the premium forever. What I want to hit on here is he pays $20,000. He gets $1 million in life insurance. So if he dies, this is paid to his beneficiaries. How's the cash value look? Not that good at all. A little bit more than zero, but I don't really have much to show for it. He keeps on paying, in this example, forever. What happens here? Well, the cash value eventually builds up. When does he get his money back? Look at this column here. What do you notice? It's age 52 when he finally sees a positive cash value, meaning he's been running a loss prior to age 52. He started this at 40 years old. Are you interested in this product for the cash value? Going back to those benefits, safety, liquidity, and the tax advantages. Probably not. Here's the same policy, but what do we see here? We're just going to stop premium payments after 15 years. So he stops altogether. The death benefit is always higher than $1 million. Total out of pocket, $300,000. By age 55, he's got $331,000. So he has more than what he paid in, and he has more than $1 million in life insurance. So long term, some people can justify this. However, if you're interested in a policy for cash value, meaning you're saying, I'm putting money into this product because of the cash value, what we just looked at is what I like to call a perfect example of exactly what not to do. So let's make this a little bit better. First thing I want is awareness. Here's something I love to say. With a whole life insurance policy, you, the policyholder, can actually choose where your money goes. It does not all have to go toward the premium. You can decide, if it goes toward premium, which first gets you life insurance, by the way, or second, if it goes toward what is called a paid up additions rider. I like to refer to this as a cash dump in because you'll feel like you're just dumping money into the cash value. You'll see an example in a moment, but this prioritizes cash value. So what we're going to look at next is this exact same policy. The first one we looked at, we're going to look at the same company, same product, keep everything the same, but we're going to make it better. We're going to have some fun with this. So step one in making it better, we've got the same company and product. We're going to look at the same out-of-pocket, meaning $20,000 per year. We'll look to fund it for the same 15-year period. This way we can see the same total out-of-pocket of $300,000. And then we'll also look at the same life insurance benefit of $1 million. Here will be the difference. Instead of just accepting what we're told and taking a $20,000 premium, which generates at least an $18,000 commission, no. We want to reduce the premium as low as the company will allow us. It's going to be about $2,000 in this example. And then put the rest into PUAs. Well, let's take a look, shall we? This will be fun. So what we've got up first is what we just looked at. This was the all premium example. And keep your eye on that and also on that. What do you notice? Same product. This has been consistent across the board. The difference now, here's your premium, just about $2,000. We also have what is called a term insurance rider. Cost for this, down here in this example. But we're plowing money into PUAs. That's what's going on. And by the way, this PUA payment covers that term cost. If you're asking, hey, am I coming up with that additional term out of pocket? Look at that. Look at your death benefit. How's this look? Better or worse? Well, it's better right out of the gates. How long do you pay into it? Stop after 15 years. Let's look at a side-by-side comparison, shall we? So what we'll start with is this example, all premium. Because if it's me, I'd like to see, show me option A, which is what everyone has shown and probably what I saw first, and then show me it right next to this side-by-side comparison. So here we go. What do you notice? Your out-of-pocket is the same. On the left, it is just the premium of $20,000. On the right, it's the annual funding in blue of $20,000. It's the premium plus the PUA payment. The total premiums represent your total out-of-pocket. How much did you pay into the option on the left over 15 years? $300K. How about the option to the right? $300K. Which one gives you more cash value? I'm going to show you a column that will make things a little bit easier to follow. Cash value difference. This is going to show how much more we have in cash value with this option compared to this option. So what do you notice? Right out of the gates, you've got another $16,500. Same company, same product, same out-of-pocket to you. Like everything's the same to the consumer. What's the difference? Well, the design of that product has more money going to PUAs. As a result, instead of taking 13 or 14 years to get your money back, you get it back in just about 4. Much more attractive. And then when we look at it long term, you've got more money, more cash value. Initially, I will have less here with this option and death benefit, but eventually it does catch up. And on that point, there are ways you can keep the same death benefit as well. In fact, let's take a look at that. So for step 2, what we want to look at is the same policy, but what does it look like, the same policy that was set up for high cash value, but what does it look like if I keep the death benefit at $1 million versus reduce it to what we just saw? Let's take a look. This will be interesting. Here's the good looking option. What do you notice here? Up top, there's the premium. There's the PUA, $20K per year for 15 years. The difference is here, we're keeping that death benefit at $1 million. With me? Now, look up top. Tell me if that changes at all. It does not. So what's the difference here? Look at year 15. This is what we just looked at on the Excel sheet when we looked at that side by side. The only difference here is we've reduced the death benefit after the funding period. This is referred to as what is called a reduced paid up option. This is optional. We do not need to decide this up front. This is an after the fact change. So we can make this adjustment even if we didn't know about it when we first started a policy. Let's look at these two side by side because this is interesting now because we're getting into the high cash value policy, but I just want to look at them side by side. So here's the first option where we kept the death benefit the same. So for you, you funded that same $20K per year. Imagine if your plan was to start with the basic one and then you learned about this, right? So now you've got the same death benefit compared to reduce the death benefit for more cash value. So the trade-off here, we're giving up life insurance temporarily. I say temporarily because eventually it does come back. But what we get in exchange is more cash value. Now for the first 15 years, because this is the exact same product, we're making an after the fact change here, there's no difference at all when we look at these two. This is the example where we get our money back between years 4 and 5. But then long term, you'll see this guy will pull further and further ahead from a cash value standpoint. And eventually, that death benefit surpasses what we see on the left too. In fact, you can see it at the bottom here. You're about $2,000 higher in death benefit, and you have more cash value. The reason why is because anytime you look at a whole life insurance policy, the product that has the most cash value long-term, typically when we're in our mid-80s, will also have the most death benefit long-term. So a high cash value product typically gives me less death benefit initially, but then eventually surpasses what I would have if I just go with an expensive whole life insurance policy. All right, let's continue on to step 3. This is where we're going to have some fun here. So we're going to look at the same product. We're going to look at someone who says, hey, I like this, but the idea of paying into it for 15 years, I could do that. Can I get the money in faster? I've got money over in this different account. I'm interested in this life insurance policy for the benefits that you had mentioned, but can I condense it? Otherwise, it's just going to be sitting in that account. Meaning, can I get the same dollar amount in of $300K per year, but over a shorter period of time? The answer is yes. So here, same policy, same company and product, different out of pocket, $50K per year, but I'm going to stop after 6 years, 50,000 times 6 years, $300K. Same life insurance, it'll be a touch higher than $1 million. A little bit different design though. Still squeezed the premium as low as we could drive it at about 10% of the total funding of $50K per year. Let's take a look, shall we? Here we go. So you'll see a 40-year-old male, same product. There's the premium, there's the cost of the term. Add them together and round up a little bit, you're at about that $5,000 minimum. Here's the PUA, plowing money into that. Here's your funding, $50K per year for 6 years. There's your cash value, $44,000 and change. Death benefit, just a touch over $1 million, $1,050,000. The reason why is it prevents what is called a modified endowment contract. Remember the three reasons why people are interested in whole life insurance for the cash value? Safe place to put money, can access it, especially while it keeps on compounding. But then 3, if I do it right, it's tax-free. One way I can do it wrong is if my policy becomes classified as a modified endowment contract. That's what the IRS looks at it and says, We no longer view this as life insurance. Therefore, if you want to access any of your cash value, the gains are going to be taxed as income. You might have a 10% penalty tax. No one wants that, so we want to prevent it. And how we prevent it is through the death benefit. The IRS formula for the MEC limit has to do with our age and total death benefit that we start a policy with. So that's my long-winded way of saying the death benefit's minimized so this guy can put in $50K per year. All right, let's look at this compared to the last example where we saw $300K going in over 15 years. All right, so here's what we got. Next tab. We'll start with the 15-year fund compared to the 6-year fund. Out of pocket is exactly the same, $300K. But what is thy difference? Thy difference is quite substantial, isn't it? This is just getting money into a policy faster and letting it compound faster. So you get the $300K in, break-even point a bit earlier between years 3 and 4. Cash value difference by the 15th year, when you have paid the same amount in with both options, $83,000 more. Same company and product, by the way. Like, it's identical. We just set it up differently. Side note, with the option to the left, you see funding of $20K per year going in. Do you think you're committed to that? You're not. What are you committed to? The minimum premium. In this specific example with the term, it might be $2,300 or $2,400 per year, call it $200 a month. That's what you're committed to. And then these PUA payments can be added at your discretion. And if you don't get the total of $300K in, you're not penalized. You just have less in value as a result. And if you pay in less and then you come into a windfall and want to throw a big amount in as a catch-up payment, you can do that too, which is pretty cool. Over here, you're committed just to the 5K, and it would be 5K in this example because the premium plus the term was less than 5. Then you can add these at your discretion for a total of 50. What happens sometimes? Someone says, hey, I got 50 in for 3 years, then life happened, I only paid in 5K, then I started paying in 50K. Even though the original illustration, the plan was to pay for 6 years, we adjusted course as time passed. Very easy to do that. To get back on track, we're making the design better. We're getting a whole life insurance policy for the cash value. We started with that basic example, and we are morphing it into a much more efficient policy. One last step we're going to take for an individual that says, hey, I got a lump sum of cash and I want to throw it into the policy. Can I do that in a short period of time? The answer is yes, depending on the company and their PUA limits. So here we go. What have we got here? Same policy, meaning the same company and product, different out of pocket. It's still a total of $300,000. You're going to see a significantly higher death benefit, though, of about $5 million. And the reason why, going back to that taxable line, we're preventing a MEC from occurring. And the design is going to be pretty cool. Let's take a look at this. Man, I love this stuff. I don't think it'll ever get old. So what do you see here? A very attractive policy, yes. Right? Same 40-year-old individual, same product, minimum premium, $5,000. The true minimum, we've got a couple term riders here, comes out to $6,300, $6,400 per year. It's about 63, but we would probably round that up to 6,500. With that said, look at this. $250K in the first year. $250 in year 1, then $50 in the second. Total out of pocket, $300. Look at this. He almost breaks even year 2. And year 3, he's positive. Between years 2 and 3 are typically the earliest we can achieve a break-even point. Now, how this is done, it has to do with the specific limit. So this is Guardian. All companies have different PUA limits. So Guardian, as a company, if we have what is called a 1-year term insurance rider attached, they're going to take our base premium, and when we illustrate these policies, when we build them in the software with a 1-year term rider, we can add 10x the base premium in PUAs per year. When the term rider burns out, so with no term, what it is 2nd through 10th year, we can illustrate 3x the base premium, and from the 11th year onward, it's 1x. You can illustrate 3x, but they only accept 1x contractually. Sometimes they make an exception, but it's important to be aware of that. With that said, notice I put 2nd year here. In the 1st year, we can add a lump sum up to 50x the base premium and just pour money into PUAs, which is exactly what we're doing here. What's 5,000 times 50? What's 10,000 times 50? 500,000. Cut that in half. 250. Okay, let's look at the comparison here. Notice the product's the same. The total out of pocket is the same. The difference here is we're just assuming someone's got excess cash now, and they're saying, hey, can I get the money in faster? The answer is yes. This guy can keep on putting in 50K per year, or just the minimum if he wants. But now we see, there's the funding, 250 up front, then 50 per year, or it's a 50 for 1 year, total of 300. Look at that break-even point. That copies what a lot of corporations do, which I love. And there's your cash value difference. Not drastic over time. This is good for the guy or girl who says, hey, the money's just sitting there. I do want to get it in there faster because I don't want it sitting in another account or something like that. Often we'll hear individuals express something like that if they go with the lump sum option. If you looked at that and said, hey, I don't know if I'm super comfortable with that small of a difference, then I would transition back to this guy, which is the 50 for 6 years in this particular example. With all of that said, I hope that this video was helpful when it comes to buying a whole life insurance policy for cash value. What I would do, just to recap, is start with step 1, which is a traditional whole life insurance policy. Step 2, I would ask for that exact same policy with the exact same out-of-pocket, but designed with the lowest possible premium. Most of the top companies will allow you to go as low as 10%. So for example, this individual originally got a quote with 20K per year going in. What we looked at is the same product with the same 20K per year going in. We just set it up where the premium was minimized. Now he saw the same death benefit, but more cash value. And then the last step is looking at really how much you want to pay in, whether it's the same 300K, whether it's less, whether it's more, whatever it might be, and see how you can optimize the cash value growth from start to finish. And if death benefit is important, make sure we prioritize that as well by setting it at the desired amount. So with all of that said, I do hope that this helps. Please let us know if you have any questions at all, and we'll see you in the next one. Thanks so much for watching.